All right, let's jump right in. Today we're taking a deep dive into the world of finance, specifically Tony Robbins' book, Money, Master the Game. We've got a whole stack of book reviews here, each with a different take on how this book can help you, the listener, take control of your financial future. Maybe even learn a trick or two from the ultra-wealthy.
That's right. Always good to learn from the best.
So we're here to sort through these reviews, pull out the golden nuggets, the key insights, so you can walk away feeling more confident and knowledgeable about your own money choices.
Yeah, it's amazing how many people just feel like finance is this big, scary mystery. But Robbins argues that it doesn't have to be. He breaks down investing in a way that makes it feel accessible to anyone, really, regardless of background, or current financial situation.
Absolutely, and that emphasis on empowerment is something that really jumps out from all these reviews. It's about taking control, realizing you have more power over your financial destiny than you might think. And one of the big ideas that keeps popping up is that you don't have to be a Wall Street wizard to be a successful investor.
Exactly. Robbins really challenges that notion. The idea that investing is just for the elite, the people with tons of money and fancy degrees, right?
Right.
He lays out this framework, his 7 steps to financial freedom, that can guide anyone on the path to building wealth.
So let's unpack those steps a bit.
Yeah.
One of the early ones that really resonated with me was the idea of making a conscious decision to become an investor, not just a consumer. It's about shifting your mindset.
It's a really powerful idea, isn't it? It's moving from passively spending to actively making your money work for you.
Yeah.
It's like going from being a passenger in the car to actually taking the wheel and choosing your own destination.
I love that analogy. And speaking of choosing your destination, another key step is setting clear financial goals. This isn't just about stashing away some cash for retirement. It's about figuring out what truly matters to you and how money can help you achieve those dreams. Do you want to travel the world? Start your own business? Buy that dream home? Defining those goals gives you a roadmap for your financial journey.
Absolutely, aligning your money with your values and aspirations. And once you have those goals in sight, Robbins really stresses understanding the rules of the game. So this means getting familiar with different investment vehicles, learning about risk management, becoming savvy about things like taxes and fees.
And this is where a lot of people get tripped up, right? They assume that understanding investing requires some sort of secret knowledge.
Yeah.
But from what I'm gathering from these reviews, Robbins argues it's more about having the right mindset and a willingness to learn.
Exactly. He demystifies a lot of the jargon and complexity that often surrounds investing. It's about empowering people to make informed decisions based on solid principles, not on hype or speculation.
Right, and one of the biggest myths he tackles is that you need a ton of money to get started. Several reviewers highlighted the power of compound interest. It's often called the 8th wonder of the world, and for good reason.
Yeah, think of it like planting a tree. A tiny sapling might not look like much at first, but over time, as it's nurtured, given the right conditions, it grows into this mighty oak, right? That's what compound interest can do for your investments. Even small, consistent contributions can grow significantly over time, especially if you start early.
That's what's so exciting about it. It's like this secret weapon that anyone can wield. And Robbins really emphasizes that time is your biggest ally when it comes to compound interest. The sooner you start, the more time that money has to work its magic.
Absolutely. He also challenges this idea that you need to be a stock-picking guru to succeed. One of the most surprising statistics he cites is that a whopping 96% of actively managed mutual funds actually fail to beat the market over the long term.
Wow, that's a pretty eye-opening number. So what's the alternative?
Well, Robbins suggests that for many investors, simple, low-cost index funds can be a more effective strategy. It's about taking that long-term approach, riding out the market's ups and downs, letting compound interest do its thing.
So it's not about trying to time the market or find the next hot stock. It's more about consistency and discipline.
Exactly. It's about making informed decisions, managing risk, and not letting emotions like fear or greed drive your investment choices.
Makes sense. Speaking of managing risk, that brings us to another key concept from these reviews, asset allocation. This is the idea of spreading your investments across different asset classes, like stocks, bonds, real estate.
Like diversifying your crops,
Right.
right. If you only plant one type of seed and a disease hits that particular crop, you could lose everything. But if you have a variety of crops, your chances of a total loss are much lower.
That's a great analogy.
Yeah.
So with asset allocation, you're essentially building a portfolio that's designed to weather the storms.
Exactly. Different asset classes tend to perform differently under various market conditions. Like stocks might do well during periods of economic growth, while bonds might provide more stability during downturns.
Okay.
By diversifying, you're creating a balance that can potentially help you ride out those inevitable market fluctuations.
So one of the reviews actually highlighted this. It explained how different asset classes behave differently in various market conditions. Like during periods of economic growth, stocks tend to perform well, while bonds may lag behind,
Right.
and then the opposite can happen during economic downturns. Bonds can provide that stability while stocks may decline.
Exactly.
So by diversifying, you're not putting all your eggs in one basket. You're creating a portfolio that can adapt to those changing conditions.
Right, and that brings us back to the importance of aligning your investment strategy with your goals and your risk tolerance. What are you saving for? How much risk are you comfortable taking? Those are key questions to consider when building your portfolio.
Absolutely. Now, one of the most intriguing concepts I came across in these reviews is the idea of learning from the 0.001%, the ultra wealthy. Robbins actually went out and interviewed some of the biggest names in investing, like Warren Buffett and Ray Dalio, to glean insights into their strategies.
Yeah, it's fascinating to peek behind the curtain, right? And what's surprising is that a lot of the principles they shared aren't overly complex or exclusive to the elite. Many of them emphasize things like minimizing loss, taking a long-term perspective, and staying disciplined.
So it's not about finding some secret formula or magic trick.
Yeah.
It's more about having the right mindset and sticking to proven principles.
Exactly. And what's really empowering is that anyone can adopt these principles, regardless of their income level or background.
One of the reviews really hammered home this point, talking about how success leaves clues. It's not about blindly copying what these super investors do, but it's about understanding the thought processes and strategies that led them to success.
You're right.
And then it's about figuring out how to apply those lessons to your own unique situation.
Absolutely.
Now, before we move on to the next part of our deep dive, let's take a moment to connect all of this back to you, the listener.
Yeah, what's sticking out to you so far? What's sparking your curiosity?
Think about your own financial goals and aspirations. How can these insights help you start taking control of your financial future? We'll be back in part 2 to delve deeper into specific strategies and tips and help you translate this knowledge into action.
Welcome back. Let's keep exploring money. Master the game. We've talked about Robbins' 7 steps to financial freedom and the importance of, shifting your mindset from consumer to investor. Now let's get into some specific strategies that can really help you on that journey.
One strategy that really stood out to me in these reviews was invest where you spend. It's such a simple but powerful concept.
It is. It's about aligning your investments with your values, right? And really understanding the products and services you're already supporting with your everyday spending. Think about the brands you love, the companies whose products you use all the time. Why not consider investing in those companies?
It makes so much sense. You're already voting with your wallet as a consumer, so why not take it a step further and become an owner, a shareholder? It's a way to put your money where your mouth is, so to speak.
Exactly. And it can make investing feel less abstract, more relatable. You're supporting businesses you understand and use regularly.
Okay, so let's say you're ready to start putting some of these principles into action. One of the reviews mentioned a strategy called pound cost averaging. Can you break that down for us?
Sure, pound cost averaging is a way to invest consistently over time, regardless of those market fluctuations. It's like setting your investments on autopilot. Basically, you decide on a fixed amount of money to invest at regular intervals, maybe monthly or quarterly, and you stick to that plan no matter what the market is doing.
So even if the market is down, you keep investing that same amount.
That's right, and here's why that can be a smart strategy. When the market is down, your fixed investment amount buys you more shares. When the market's up, you buy fewer shares. Over time, this helps average out your cost per share and potentially reduce your overall risk.
It's kind of like buying groceries, right? If the price of your favorite cereal goes down, you might stock up, buy more. If the price goes up, you might buy less. Same idea with pound cost averaging. You're taking advantage of market fluctuations to potentially lower your overall cost.
Exactly. It's a great strategy for beginners because it really takes the emotion out of investing. You're not trying to time the market or predict when to buy or sell. You're simply sticking to your plan and letting the power of consistency work for you.
I love that. And speaking of taking the emotion out of investing, Robbins really emphasizes the importance of focusing on what you can control, We can't control what the market does, but we can control our own behavior, right?
Absolutely. We can control how much we save, how much we invest, and how we react to those market fluctuations. One of the biggest mistakes investors make is letting fear or greed drive their decisions. When the market drops, they panic and sell, often locking in losses. Or when the market is soaring, they get caught up in the hype and buy at inflated prices.
Right, so it's about staying disciplined, even when things get a bit bumpy. And that brings us back to having a clear why for investing. If you're deeply connected to your purpose, you're less likely to be swayed by those short-term market swings.
Exactly. Your why acts as an anchor, keeping you grounded and focused on the bigger picture. Now, when it comes to choosing specific investments, one of the most widely discussed strategies in these reviews is Ray Dalio's all-weather portfolio.
Oh yeah, I've heard of that. It's designed to perform well in any economic climate, right?
That's the idea. Dalia's portfolio is based on the principle of diversification, spreading your investments across different asset classes that tend to react differently to various economic events.
So it's like having a financial umbrella, right? That can protect you from the rain, the wind, even the occasional hailstorm.
Exactly. Now, it's important to note that Dalio's portfolio emphasizes a heavier weighting toward bonds than many traditional portfolios. This is because bonds have historically provided stability during market downturns.
But I remember reading in one of the reviews that that heavy bond allocation might not be as effective in the current market environment. Given those historically low interest rates, it's a good reminder that there's no one-size-fits-all solution when it comes to investing.
Right. It's crucial to understand the principles behind any investment strategy and how those principles might apply in different market conditions. What worked in the past might not necessarily work in the future.
That's why it's so important to do your research. Understand the risks and potential rewards of any investment before jumping in. And it's also why seeking professional advice can be so valuable. A qualified financial advisor can help you assess your risk tolerance, your financial goals, and tailor a portfolio that's right for you.
And speaking of seeking advice, one of the reviews mentioned this great piece of wisdom from Warren Buffett. He said, "Be fearful when others are greedy, and greedy when others are fearful."
That's one of his most famous quotes. It's about going against that herd mentality, right?
Exactly. When everyone else is rushing to buy a particular asset, driving up the price, that might be a sign to proceed with caution. Conversely, when everyone's selling in a panic, that might be an opportunity to find bargains and capitalize on market inefficiencies.
But that takes a lot of discipline and a strong stomach, doesn't it? It's easy to get caught up in the emotional roller coaster of the market.
It does take discipline, and that's why it's so important to understand your own emotional biases and develop strategies to avoid making impulsive decisions, driven by fear or overconfidence. One way to do that is to have a clear investment plan and stick to it, regardless of what the market is doing.
Makes sense. And another key takeaway from those Robbins interviews was the importance of investing in what you know.
Yeah, this means choosing companies or industries that you understand and believe in. It could be a sector you're passionate about, a company whose products you love, or an industry where you have some expertise.
This makes so much sense. If you have a deep understanding of a certain industry, you're more likely to be able to spot trends, identify opportunities, and make informed decisions.
And it can make investing more enjoyable and engaging. You're not just looking at numbers on a screen. You're investing in businesses that resonate with you.
Now, another important principle that Robbins emphasizes is understanding the difference between price and value.
Yeah, it's not just about finding cheap stocks. It's about identifying companies that are undervalued relative to their true worth. This requires doing your research, looking at the company's financials, assessing its long-term prospects.
So it's about being a bit of a detective,
Yeah.
right? Looking for those hidden gems that the market might be overlooking.
Exactly. It's about separating the hype from the fundamentals, making investment decisions based on solid research and analysis. And this often requires patience. Value investing is not about making quick profits. It's about identifying companies with strong long-term potential and holding on to those investments, allowing them to grow over time.
So to sum it all up, it seems like successful investing is really about combining knowledge, strategy, and a healthy dose of discipline.
That's a great way to put it. It's about understanding the principles of investing, choosing strategies that align with your goals and risk tolerance, and then having the discipline to stick to your plan, even when things get volatile.
Now, before we move on to the final part of our deep dive, where we'll talk about putting all of this into action, let's take a moment to reflect. What are some of the key takeaways that are resonating with you most strongly?
Yeah. What are you starting to see differently about the world of investing? What's sparking your curiosity? Or prompting you to rethink your own approach to money?
We'll be back in part 3 to explore those questions further and help you translate these insights into actionable steps. Don't go anywhere. Welcome back to the final part of our deep dive into money. Master the game. We've covered a lot of ground, from the psychology of investing to specific strategies like asset allocation and pound cost averaging. But now let's bring it all together. Talk about what this means for you, the listener.
Yeah, we've explored a lot of powerful concepts from these book reviews, and now it's about taking that knowledge and putting it into action. Remember, financial literacy is an ongoing journey. It never really stops.
You're right. It's not about memorizing facts and figures. It's about developing a deeper understanding of how money works, making informed decisions that align with, well, your values and your goals,
Exactly.
and recognizing that you have the power to shape your financial future.
That's a big one.
One of the most empowering messages that came through in these reviews was that you don't need to be a financial expert to succeed. You don't need to have a lot of money to get started. What you do need is a willingness to learn, to take action, and to stay committed to your goals.
And you don't have to go it alone. There are so many resources available to support you. On this journey, it could be a financial advisor, a trusted friend or family member who's savvy about money, even a great book or podcast.
Absolutely. The key is to find resources that resonate with you, that speak your language, and inspire you to take action. And remember, this deep dive is just the beginning. It's about sparking your curiosity and giving you a foundation to build upon.
Think of it as a launch pad. Now it's time to take those first steps. Start exploring the world of investing on your own.
Exactly. And one of the best ways to learn is by doing. Maybe you open an investment account, start researching different types of investments, or even just commit to reading one financial article a week. Small, consistent steps can lead to big results over time.
They really can. And remember, no need to feel overwhelmed. You don't have to become a financial whiz overnight. Just start with something that feels manageable and build from there.
Now, as we wrap up this deep dive, we want to leave you with a final thought-provoking question. Knowing what you know now, what one small step can you take today to start mastering your own money game?
Maybe it's setting up a budget, automating your savings, or finally getting around to opening that investment account you've been thinking about.
Whatever it is, make a commitment to yourself to take that step. And remember, the journey of 1,000 miles begins with a single step. So start today and keep moving forward.
Keep learning, keep growing, keep striving to master your own money game. You got this.
Thanks for joining us on this deep dive into money. Master the game. We'll see you next time for another fascinating exploration.